When we talk about global debt, it's not just about numbers on a balance sheet, it's about how deeply connected economies really are. A debt crisis is one country can ripple through financial markets, trade flows, and even currency values around the world. Emerging markets face particular challenges, often borrowing in foreign currencies that can swing against them, while major powers and international institutions shape the rules of the game. To dive deeper into these interconnections, I'm joined by StoneX Director of Global Market Strategy, Vincent Deluard. Thank you for joining us, Vincent.
Always a pleasure to be here.
So, how can debt troubles in one country spread to another? And what are the main channels of contagion?
I mean, there are many channels from the financial to the real. Uh, Obviously, things happen fast in financial markets, so that's what you see it first, and it has to do with the interconnection of the global banking system. Broadly speaking, we had a system of fixed exchange rate and capital controls slightly after World War II that progressively got entangled with capital controls being mostly abolished, fixed exchange rates being allowed to float, and banks being allowed to borrow from one another from what's called the Eurodollar market. So this is a market that emerged again after World War II, mostly originally Soviet exporters were earning dollars by selling commodities, gas and oil, to Europe and including the US as well. And they started to lend these dollars, and then other banks borrowed this dollar on what became called the Eurodollar market because it was based in Europe, not had nothing to do with the euro, and that quickly became really the dominant source of global funding for if you're a Japanese bank that needs to export or hedge some a dollar exposure. That's where you'll do it, and that's a market that is mostly independent from the Fed, market driven, and it works very well. It's very efficient, but once in a while, of course, liquidity risks emerge, and we have crises.
So let's focus on emerging markets. They are particularly vulnerable when it comes to debt. Could you explain some of the key challenges they face, especially sort of currency risk, external debt?
Yeah, so the biggest risk really comes from what economists have dubbed the original sin. And the original sin is emerging markets' inability to borrow, especially at the long end, in their own currency. And then that has to do with the fact that investors do not want 30 year of exposure in the Turkish lira, the Argentine peso, or the Egyptian pound. And, if you plot a chart of the Argentine peso over time, you'll understand why no one would want that exposure. So if you are a emerging market company that needs long-term funding in order to build a factory or something like that, you're not going to find that. No bank is going to extend that credit to you unless you borrow in a hard currency or you issue bonds in a hard currency. So typically that's in US dollars, although for some market, the euro and the yen also play a role. Now, after you've done that, you now have a problem because most likely your revenues are going to come in Turkish lira, Egyptian pound, Argentine peso, and your liability is going to be in dollar, euro, or yen. You don't really have a great way to hedge that because this long-term hedging market is not very liquid or prohibitively costly. So you run the risk of, asset liability mismatch and getting squeezed, not being able to pay back your loan. If you're not able to pay back your loan, then the bank that issued the loan is going to be a problem. It's going to be looking for capital, and that's how the crisis spread across the banking sector.
And in what ways do the major global economies, big lenders, or institutions such as the IMF, China, multilateral banks influence global debt dynamics?
Yeah, so they obviously provide capital That was initially the role of, in the original Bretton Woods system. You had kind of the World Bank and the IMF, whose role was to handle this crisis, provide capital for long-term funding in emerging markets. That was the goal of the World Bank. And then the IMF was more handling the liquidity crisis that would happen. They also provide macroeconomic supervision, stability, trying to promote the kind of reforms that would facilitate the emergence of a more resilient system with better funding, more stronger local markets, so that these problems um, heal over time. And then to some extent they have. Like if you look at the share of long-term funding in local currency, it's growing even in countries that traditionally had balance of payment crisis. I mean, Southeast Asia, for example, was a good example of catastrophic crisis in the late 90s, which is fine now. It's an exporter of capital. Most funding is done in local currency. China obviously is playing a role as very often trying to replace Western institutions with loans in yuan. So I would say, yeah, there is certainly um, a a lot of capital that can be deployed outside of traditional lending.
And are there historical precedents of cross border contagion, and how can we learn from them to mitigate current risks?
Yeah, I mean the one that comes up to mind, certainly the most um, violent one in terms of its consequences, is the East Asian crisis of 1997, 1998. It started with um, the devaluation of the Thai baht, and then very rapidly in short succession, we saw the Indonesian rupiah fall, the Korean won, pretty much all Asian currencies. And it was very brutal, and I would say somewhat unnecessary. I mean, because these were fundamentally healthy economies. These were economies that were growing quite well, that had a very high domestic savings. And I mean, the crisis was ultimately contained, obviously, with IMF intervention and liquidity swaps, but not without a prohibitive cost. I mean, if you think about Indonesia, this is the end of the 20 plus year rule of Suharto, which is probably a good thing, I guess, but certainly led to people dying in the streets. South Korea, the unemployment rose a lot. I mean, fun fact: I'm watching Squid Games with my kids at this point, and I'm kind of thinking, oh, this is when you see the VIPs in the room, and like this is some sort of a metaphorical description of the kind of society that was left by the IMF bailout, at least how it was perceived in South Korea. Like there's a reason why we see so many really violent Korean movies about dog eat dog world, and then extreme competition between people and greed. That's in some ways that all boils back down to this botched bailout by the IMF, which really scarred a generation in an economy again that was fundamentally healthy. So again, yeah, this crisis can be solved. The solution, typically the IMF medicine, right, the one that um, the Washington consensus involves, getting a loan from the IMF or a currency swap from the Fed, but in exchange, accomplishing reforms that, in the eyes of the IMF, will make growth more resilient. And these reforms typically involve opening up the banking sector, cutting government spending, and yeah, in the short term, these things create recessions and a lot of pain for the average individual.
And looking ahead, which countries or sectors are most exposed now to interconnection risks, and what policy actions might reduce those risks?
Yeah, so I would if we take kind of a broad overview of the emerging market landscape, and focusing on the big players, the one that all have systemic potential, I would say it's quite healthy, or healthier than it's been for a long time. A lot of that has to do with the fact that the dollar is very weak. We've had the weakest start for the dollar since I think 1973, since we went out the gold standard. So when the dollar falls, it's a windfall for anyone who borrowed in dollars, right? I mean, if you include total return, you see currencies like the Brazilian real, the Colombian peso, the Polish zloty outperformed massively. So anyone who borrowed in dollars is getting a windfall. So there's very little stress. Also among the very big borrowers, your country like Brazil, like South Africa, like Indonesia, your big emerging markets, there's been a shift to more long-term funding and local currency funding. So I would say by and large, the big guys are okay. But of course, you always have smaller economies that are getting squeezed. I would think a place like Ghana, Pakistan, Egypt is always on the brink of a crisis. Turkey has been weak, and the latest one, of course, has been Argentina, where if it had not been for the last minute intervention of the U.S. Treasury and really just signing off a $20 billion loan in order to get the desired election outcome, we would have had a full-blown currency crisis.
Well, thank you very much for your analysis once again.
So always a pleasure to speak.
For more videos like this, please do like and subscribe.